Morning all. Thanks very much for joining us for episode 2 of Provision. For those that joined us last week for the season premiere, welcome back. Once we've done some hopefully snazzy editing, we'll be uploading it along with some other sort of helpful pitch content to the Provision community. For the newbies today, it's VK from ProFounders here. I'm joined by Rogan and Joe from the ProFounders team also. Don't know if you want to say hi.
Hi everyone.
They'll be in the hot seat today answering questions in today's live Ask Me Anything. Here at Provision, we're demystifying venture and fundraising for early stage founders. After last season, we got a fair few questions about a specific topic, so we thought we'd cover it off with a full video. Today, Rogan and Joe will be answering questions about term sheets and negotiating with a VC. We received a few questions beforehand, but as always, feel free to submit your questions via the Q&A and I'll put them to the whole team. As before, we'll be limiting each answer to 90 seconds. So hopefully we'll be able to get through more questions and we'll also keep Rogan and Joe honest. So without further ado, I'll go ahead and open up the questioning. Fingers on the buzzers, guys. So the first question we had here is, what's the difference between a commitment, a soft commitment, and a term sheet? And can I tell people I have terms if someone has verbally told me they'll invest? I'll start there.
Soft commitment is worth almost nothing. And personally, when I hear that, I just think that either there's a degree whereby people are abrogating his responsibility or that it's just not true. In terms of telling people, yeah, but be honest, because I think people don't realize this, but we do all talk to each other, VCs, and I actually think it's a healthy thing and personally would encourage all VCs to talk about it. So, you know, as long as you're telling the truth, absolutely, because then you're being transparent.
Yeah, I'd say the soft commitment isn't worthless, but it's definitely not as valuable as, I guess, if you're going to order them. I'd say kind of money wide in your bank already is probably number one, followed by a term sheet to lead the round, and then the worst of all is a soft commitment. But it does allow you to I guess get an idea that once you do get a lead, what are the different pieces of the jigsaw puzzle that
but Joe, the difference is, as a VC, if somebody tells you to have a soft commitment, does that change your view one iota about the opportunity?
A soft commitment normally means conditional on other things, so it depends what those conditions are. If it's only if Sequoia's investing, then yeah, it's pretty worthless.
Okay, interesting. Next question then that we had, are term sheets confidential? Can I speak to other VCs about a term sheet that I've received?
So if I start on this one, term sheets are, until they're signed, completely non-binding. And even once they are signed, they're legally non-binding, apart from a couple of points on them, one of which is confidentiality. The other is exclusivity. So you are able to speak to other VCs about a term sheet you've received and haven't signed. There is a bit of a loss of trust, I guess, if you kind of wave around a term sheet that a VC's given you, and you might jeopardize that relationship. But once you have signed it with a VC, you need their permission to go and tell other investors about that.
Only if that is one of the contractual terms in the term sheet. I've seen term sheets that don't have that in. And I guess even though it's not necessarily the best for us, founders or a VC, I think entrepreneurs should and do shop round a term sheet. Well, effectively, we always say to people, look, it's the market that sets the price. So, if you can get a better price, then that's probably good for the company. I would expect a company to shop around the term sheet. And I think we put that in because it's a bit historical.
But you'd feel a bit hurt if they shopped around your term sheet, because you'd be saying, why aren't you just signing it?
No, I might feel I lost out, but that's different to being hurt. I'd want the founder to be to be aggressive and optimizing, because hopefully we'll be in the same corner one day.
Okay, interesting. I guess sort of adjacent to that point, then, someone's asked here, should I go back to a fund that rejected me once I have a term sheet? I don't know what you guys think about that one.
To gloat or to try and get them in the round?
I assume it's not to gloat. I assume it's to get them interested again.
I guess
you should try to do the best, shouldn't you?
Yeah, I guess it depends. I mean, I guess if you're going back to them to try and get a better rival term sheet, but they've already said no, then I'd be asking kind of what suddenly changed their mind. And it sounds like if they're a bit of a sheep if they're only in because someone else is in. So it's not the best sign. I guess there are potentially some valid reasons, if these are the reasons they gave for the rejection, that a new term sheet could change. For example, if there was a company we really liked in Turkey, but we thought, we're too far away to provide the kind of support and governance we want, there would need to be a local fund leading the round for us to be interested, then maybe it could make sense for us to, after rejecting them, take another look if they've got a strong local partner.
I think that's right. I mean, it does depend on the rejection. And as Joe says, would you want somebody as an investor whose only reason was that somebody else had liked you? I mean, I think this is such a crucial relationship both ways, that you both want to be excited about each other. But if it's because, as you said, either the size of the round or the location, then yeah.
Okay, cool. This is a question, I guess, on competition. How can I get VCs to collaborate in a round but maintain the competitive tension?
I'm going to put that in the over-optimization category. I mean, the reality is that there are some kind of pretty standard conventions, I think, that all investors will kind of adhere to in terms of dilution and the preference or non-preference shares and the kind of key terms. So really, I think, do you want to be, as a founder, optimizing for minutiae, little variations on the price, or do you want to be optimizing for a round and for a bunch of investors that will make the rest of your journey easier? And for me, it's the latter. So I would basically allow everybody to talk to everybody.
I guess, yeah, the risk you run is because VCs do talk to each other and share deal flow. The risk you run is if you've not got that many VCs you're having conversations with and they collude, then you're not going to get the most competitive price, which it could happen. I mean, it shouldn't happen, but I guess the way to defend yourself against that is just to make sure you're speaking to enough VCs so that there's still competition, and probably to not tell the VCs who else you're speaking to.
But also, it's a case of why are you if you're talking to multiple VCs because each one has to write only a part of the rounds, you're not going to optimize your pricing anyway, in my view.
Yeah, got it. So this is a question on. So we've actually received a question, and I'm going to meld two because they're relatively similar here. One of the questions we received beforehand was, what terms do VCs care about other than price? And one of the questions we just got live is, what leverage do VCs use in the negotiation process to get a better deal? And should founders stand their ground with the equity they are prepared to offer?
I mean, let's say there's multiple questions. So the deals, the things that we care about really, really passionately, I guess, is, obviously the pricing is important, but strangely, VCs do also realize that founders need to have a decent chunk of the equity as well, because that's part of the reason that this is being done. So it's not, we don't try to be super aggressive, I guess. We like an option pool because that gives your currency to get new employees in. We like a vesting period on founders' equity because that ties the founders to a company. And we like preference because we're working for the extremes there, but we don't want to suddenly get turned around and everything gets sold and we only get a percentage of it when we should get it all. The leverage, simplistically, that we have is whether we invest or not. Founders should definitely stand strong if they don't fancy the investment, but it's not just about the equity.
Yeah, I guess the only other term I'd add into that, which is pretty important for us, where there's opportunity for misalignment of interests, is the drag along. So, if the company is suddenly, there's an acquisition offer for the company at the same price that we've just invested in the next day, that's not a return for us, but it could be a meaningful sum of money for the founders. So we need to protect ourselves against that.
Founders don't want to protect themselves against that necessarily. And also we have protection to the majority. We often, with our preference shares, will have requirement for a majority of the investors as well.
Got it. So I guess actually on that topic and sticking with it a little bit, one of the questions we had is there anything off limits in a negotiation? And I guess you sort of touched a little bit on leverage being we can walk away, but is there anything off limits?
By off limits, I guess you mean what are the
things that will call
will not move on, and I think some degree of reps and warranties and founder vesting, I think are always going to be part of it. I think most VCs will have to take some liquidation preference. There's opportunity to negotiate on all those points, but they will appear to some extent in the document, I think. But you should be pushing for it to be as founder friendly as possible. So with liquidation preference, that's 1 times non-participating.
I don't think anything's off limits. And the only thing I would say is that if people try very strange stuff, I actually don't mind it. I like the innovation of it. But it's going to make us worry about how they're going to negotiate the next round. And I think we've touched on this before, VK, and some of the previous provisions, that this is a journey. And so we have to be comfortable that the founders can be able to raise the next round. And if they're totally off whack, then they're going to be at the next round, and that's a bad sign. But broadly, not only would I love to discuss anything, I'd love to be more innovative in our terms as well.
All right. So question here, which I know Rogan has discussed before actually and touched on before in a provision. If we can't agree on price with a VC, should I push to do the round as a convertible?
No.
I mean, you're still going to probably have to talk about price. It might be a cap, but that's effectively still a price in inverted commas, and it might even be a discount to that. So either the cap's ludicrously high, in which case, if we've been arguing about price, we won't go for that either, or it's very low, in which case the founder's disadvantaged. So personally, no. I think this kind of convertible, all it stops you from having to talk about the terms is kind of the wrong way of looking at these things. We're trying to get together with a company to be proper partners. We should talk about everything now, discuss our way through it, and hopefully that's another sign about why we should be working together, how we do that.
Yeah, I think the reason you're disagreeing on, it depends on the reason you're disagreeing on price. I mean, the advantage of a convertible is it can be done quickly, and it pushes the proper fleshing out of the terms to a later stage. If the reason you're disagreeing on price is because you're miles apart, then doing a convertible is not gonna change that. It could make sense for existing investors where they're finding it hard they're already committed to the company, but they're finding it hard to find a price.
Got it. And by the way, like I said, pushing the terms out, the discussion of the terms, I'm not sure why that's an advantage. You're still going to have the difficult conversation. Might as well have it before you get into bed together.
And so one of the questions actually that we got was, should we spend a lot of time negotiating the cap of the convertible? And it sounds like, the answer to that would be yes, that's one of the key terms which you should spend time negotiating.
I mean, there are less terms to negotiate on a convertible. So yeah, I'd be pretty keen to do that. But you might as well have done a price brand as well.
One of the questions then on actual negotiating style, should I negotiate with my VC via email or I guess live? And by live, I assume, over a Zoom call also counts.
Email. I just think that negotiation of VCs are very familiar with term sheets and will negotiate them several times a year. So you're already at a disadvantage as a founder. So just by slowing up the back and forth through email, you're giving yourself a chance to think, to confer with your co-founder, with your lawyers. So you're kind of trying to level the playing field a bit, I think, in the power of that negotiation.
I half agree, and I think it is an important point that there is a disconnect between the experience of the VCs and the experience of the founders. But as I've said in some of the other things, this is a relationship, and I don't conduct, maybe because I'm an old fogey, but I don't conduct my relationships via email. I do it with talking to people. I think it's perfectly fair to have that conversation and to take it away and to think about it. And one of the things we do, and this isn't meant to be a kind of advert, but I think funds should do this, is we try to explain not just this is what the terms are, but why we're putting them in and what the possible kind of downsides are at the extremes. They need to go away and check that as well, but actually it should be a discussion, I think, rather than a negotiation.
Got it. Cool. Question here on advice. How can I get independent advice on a term sheet, and who can I go to? I don't know if you have any say on this.
Well, existing investors, if you have them, lawyers that you hire, or I guess people that have gone through it before themselves, whether that's friends or other founders and speak to.
You could also, there are online tools as well. So Seed Summit have a standard term sheet, and they do a good job of explaining what all the terms mean. But I think it is one of the big challenges, of course, when you're starting off as an entrepreneur, is you have very few trusted advisors, and lawyers cost money and stuff. So I agree, Joe. You've got to go and talk to friends, and ideally, if you could talk to a friend who either was or knew a VC, then you're going to get the VC perspective as well.
Got it. So I guess two questions then on a similar theme around the diligence that a founder can do on the VC side, so the other way around. What kind of questions should a founder ask before signing a term sheet off the VC?
Questions related to the partnership or related to the term?
Related to the fund, the partnership, basically understanding before they sign and agreeing to work with the VC.
Personally, I would do due diligence outside of the partnership. I mean, the key things of the partnership that you need to know, if you care about follow-on, which you probably should do, is how much capacity the fund has to follow on and what that kind of journey will look like in the future. But the real key is actually to ask other people about their view about the fund, because surprise, surprise, we're going to say good things about us. And I think we said this before, but I would never ask the fund to put you in touch with founders, because we will always put you in touch with the founders that we think will say the nicest things about us. So just go out there and find out what the reputation is about how they work together. That's the key, is how do you work with your portfolio companies, and is that something that you as a founder want that style from that investor?
I think in particular the companies, the portfolio companies in the past that maybe haven't gone well is the true test of whether they were helpful or not. So I don't know, go on Crunchbase and see those that kind of sadly didn't work out.
Yeah.
Got it. Yeah. Cool. Question here on a specific, or there are a few questions here on specific terms that we sort of talk about, but perhaps other people aren't super aware of them. You touched on warranting before, reps and warranties. Question here, what is warranting and should I worry about it?
So essentially, reps and warranties are assurances that the founders make that everything they've been saying in the build up is honest, and there's no kind of skeletons in the closet that they're hiding. And they will be what you sign in the docs is an element of kind of financial claim that can be made against either the founders personally or the company if that was found out to be not true. So I think that it's something that founders should be very careful with and spend a lot of time making sure they're right. But hopefully it's something they shouldn't worry about, because there's only an issue arising if they've kind of misled investors.
I think the key thing for founders to think about is how wide a warranty you give. So if the warranty can be only stuff that the founders actually know, and that should be a pretty easy warranty to give, because you're either telling the truth or you're not. The challenge, I think, comes when it's actually knows or should have known, because what is it that you should have known? And then there's another thing, which is, can you just disclose everything by dropping hundreds of files and say, there you are? To which the answer is no,
find it.
Specific kind of thing. But it goes down to the honesty stuff. Broadly, we should trust the founders should trust us, and the founders should be telling the truth, so they shouldn't have a problem with the world.
I think you've got a question in the chat as well.
All right.
Okay.
Yeah. So there was a question on closing the rounds in chunks, and I think the question in the chat is also similar, although it goes into a bit more detail. What are the types of term sheet structures for the investment funds, such as funding by milestones, increased subscribers, revenue targets? What are the common approaches here for funding in chunks or by milestones?
I've always absolutely hated those, actually, for the simple reason that it just overcomplicates. I mean, look, either the milestones are super easy to achieve, in which case it seems pointless to put them in, or they're really difficult to achieve. As we all know, companies don't always hit, seldom hit their forecasts. So then it just becomes a renegotiation or potential renegotiation further down the line. I mean, ideally, you should have a round, you try to achieve something, and it's a big milestone, not just kind of a certain amount of the rate. The only areas that I've seen it work is more for different reasons, which are kind of financial reasons. Either if you have negative interest rates, which you do in Europe, or if you're just trying to, as a VC, improve your IRR, you could stagger the payments, but not on milestones. It's just, this is a little bit of financial engineering, so that on the one hand, the portfolio company doesn't have to pay interest to have its money stored. And on the VC side, we get a mildly better return from an IRR point of view, because it's based on time value of money, and so we haven't had to make the investments.
Got it. Actually, on that, sorry, Joe.
Well, the only thing I was going to add is if the milestones and future funding that might go in is also, the valuation is also dependent on milestones, and that's a clear misalignment of incentives, right? Because the VC will want you to almost hit the milestone but not quite, and the founder will obviously want to hit the milestone, so you want to be working together.
Got it. I guess a question I have then, follow up there, on that point, how, and only because I haven't seen it, how flexible are those structures? So, if you agree to tranche the investment and say growth happens to be happening a lot quicker, you decide to invest a little bit more quickly, how easy is it to shift perhaps the timing of those payments after it has been agreed?
Well, you wouldn't have seen it because we don't do it, but everything is
easy, yeah.
Relatively easy as long as people agree. I mean, as with anything, a contract is fine. It can be changed incredibly easy if all parties agree to it. But if it doesn't, that's your default position. So if you had milestones, and if you wanted to rip up that milestone and just say, look, we're just going to invest another X million at Y million and everyone's agreed, simple as you like.
Cool. Question here, which I think we've also touched on before. How should I think about protecting, maintaining control post-investment as a founder?
Depends what control means. I mean, by definition, you're giving up control to varying degrees by giving other people equity, both from a kind of regulatory point of view. You have protection of minority interests, but as we've touched upon in terms of the terms, often, and we put in terms that, or certain things that need to be agreed by the majority of the investors. And so they will be big capex expenditures, acquisitions, changing the business, all of that. And so without that majority consent, you're not going to be able to do those things. So you have effectively given up some of the control. However, you are still the founder, you are still the CEO, and that gives you a lot of power to exercise what you want to do, and that's what we're backing. So that should still work, but you're not going to have infinite 100% control.
Yeah, makes sense.
Yeah, I mean, as minority shareholders, we're backing teams and their visions. So if you're just trying to do things that execute on that vision, then the investment majority decisions and the board approvals shouldn't get in your way, but potentially could provide some good kind of governance and checks on how you're doing things.
Perfect. Guys, we're coming up on time, so I think it's probably about time to wrap things up. There were a few questions that we got asked beforehand. I think we've answered all of the live ones. If there are any further questions that you feel like we didn't cover properly, or anything that we mentioned, I'm aware 90 seconds is a short period of time to talk about some of the more kind of involved parts of the term sheet. Feel free to shoot me an email. It's vk@profounderscapital. We'll also be uploading this video along with some other helpful information about term sheets to the Provision community. So I would encourage you to check that out too. Thanks very much for taking the time to join Provision episode 2. Thanks, Rogan and Joe, for answering the questions. As always, we're looking forward to our next episode in 2 weeks' time. We'll be inviting some guests along for the rest of the season, and we're talking about some interesting topics with them. So stay tuned for more.